Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at the MarketSide studio, we have Joe Cavatoni, Chief Market Strategy North America with the World Gold Council, to discuss why prices will see some support through the end of 2023. Joe, it's great to see you as always. Welcome back to TradeTalks.
Thanks for having me.
So let's talk about what interest rates are, where it's happening. It seems as if tightening cycles around the world are starting to slow down a bit. What is Market Strategist pointing towards in terms of a recession?
So right now, what we're looking at is, let's back up just a bit on gold. Gold has basically had a fantastic performance for the first part of the year, considering that rate hiking environments are usually headwinds for the market. And actually, we've seen just about 5.5% year to date in terms of performance. Now, we're hearing that and seeing that, and we're getting indications that we're reaching the end of this rate cycle, hike in particular in the US market. What that'll mean is that we will start to see the repercussions of those rate hikes feed into the economy. When we see that develop, we'll see whether we're entering a recessionary environment, a softening of the US economic environment, or if the Fed can actually land a pretty strong soft landing, and ultimately we'll see how that plays out. Now, what does all that mean for us? It means that the environment for safe haven assets will continue to increase if we see those types of environments where the recession and the economic strain on the US economy develops. So we've got our outlook out, the mid-year outlook, and we've actually got a nice summary chart in there that talks about the factors that will develop. The two that are really interesting to pay attention to are those that are weakening US economic consensus and ultimately the recessionary environment or a credit crisis type of an environment where you have a weakening of risk assets and a flight to safe haven assets like gold.
Yeah, well, I mean, it's a good point that you make, because while the interest rates went up as much as they did in just 9 months, you have to think about all the lagging indicators too, and they take a little bit longer than the interest rate cycle that we saw.
That's exactly right. What we're challenged by right now is trying to time this. Time this end to the rate hike cycle to dampen the effects of inflation, trying to time how quickly and how fast it's going to feed into the economy. And that's really been the challenge, and we were actually looking and expecting for that to play out more along the lines of this summer. But as of just this week, we're hearing that there's the potential for further rate hikes. So this is going to continue to develop. It's going to continue to develop throughout the course of the second half of the year. But remember, we've had a strong first half of the year, an event risk in the beginning of the year. March, we had the banking crisis, which led to a strong surge in the gold price. We've come off that, but we're seeing a natural floor. And so you have a 5.5% return year to date, and indications that if we land in this US type of economic recessionary environment, we can show you the detail around how gold performs in recessions. You'll see gold having that strong performance again, because the flight to safe haven will play out.
Yeah, I mean, after the jobs data that we got, I mean, nearly doubled estimates that we got this morning. I mean, that kind of lays the case out for a couple more interest rate hikes as well.
Correct. It's going to continue to take place. It's going to continue to develop. And look, it's not only just a US economy thing. Remember, gold is a global asset, so we're looking also at developed markets in Europe in terms of where their rate hike cycles are, where they are in the recession cycle. There's demand for gold in those markets that can actually start to look to kick in as well. Year to date, we've seen significant flows out from the European ETFs for gold, and actually a reasonably strong hold for the US ETF market for ETFs. Overall, the ETFs globally are down about 1.5% in terms of their total AUM, but Europe's really taking money off the table from the gold perspective. When do they start stepping back in? We'll see. We've got to keep an eye on that as well.
So tighter credit conditions, in theory, should be a positive impact for gold.
Correct.
Right.
Tighter credit conditions will be a positive impact for gold. A weakening dollar will be an impact that will be favorable for gold. And in general, risk off or risk concern types of environments will be favorable for gold, for sure.
You mentioned weaker dollar. You and I spoke about this last time you were on, de-dollarization.
That's right.
Has that story continued? What's happening there?
There's definitely talks of a de-dollarization kind of environment. Now, I want to be careful because de-dollarization is a very strong term.
Right.
What we're really talking about and what we're looking at are the effects of the US economy on dollar-based holdings that are either held here domestically, and what we've seen actually has been a flight to quality and people flying into money market funds and holding their dollars and their savings in those kind of interest earning instruments. But what we're seeing internationally and globally is this diversification of their reserve portfolios at central banks and international investors, and moving away from reliance on the dollar. So that's going to take a long time for it to be removed or de-dollarized from our ecosystem. But what we're really seeing, our central banks and our survey report that we do on an annual basis has given us an indication that not only the dollar but the euro over the next 5 years will likely be less relevant to the emerging market, developing market central bank community. So you're seeing people moving monies away from dollars, dollar-based assets, and diversifying into safe haven assets or assets that won't necessarily be so hitched to the U.S. economy like gold. You're seeing increases in the reserve portfolios. This has been almost a 14-year trend. This month, we actually have had the first month where we've actually seen selling by central banks. That's really a unique phenomenon where Turkey has been a huge seller of gold domestically into the hands of retail onshore. So that number kind of skews what the data looks like, but generally the trend has continued. So you have central banks, including those emerging market central banks, continuing to buy gold.
Right. But to your point, de-dollarization and diversification, they're two very different things. And at the end of the day, you mentioned this when we spoke last quarter, that, I mean, the dollar and how liquid it is and how business is transacted. I mean, you're not going to completely walk away from the dollar.
We're not, and I think it's not right to think that this will happen quickly. What you will see is an ongoing trend of assets moving into a number of different investment opportunities. But gold's definitely been the recipient of a move away from dollars and reserve portfolios, for sure.
All right, Joe, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.